That's much better, probably for all of you and for me. DCA is USAID's legal authority to provide partial credit guarantees. And for those of you who look at me and think, well, what on earth is a partial credit guarantee? What that is it's a risk-sharing mechanism with banks, microfinance institutions, non-bank financial institutions, where USAID comes in and says, there's a financing gap in X sector. We know that this sector is important for development, and we're going to help you move into that sector or develop new products for that sector or provide better loan terms for borrowers in that sector by sharing risk with you 50-50. So for every dollar that defaults, the US government pays 50 cents. So our guarantees are backed by the full faith and credit of the US government. And typically, as I said, it's a 50% pari passu risk share with the financial institution. DC is a tool that is implemented through our USAID missions in the countries where we work. So we like for our guarantees to align with mission strategies, and our office has been working closely with Scott on thinking through where and how DCA might be applicable in the Jordan context. But increasingly in the last, I would say, 5 years, instead of missions coming up with ideas and bringing DCA in, DCA is actually out in the field talking to the private sector, talking to implementers, trying to do exactly what we're doing here to say we know that there are gaps with CBO financing in the long run, and how do we reduce those wait lists. We know that there's gaps for access to finance, to hydroponic systems for users that are really interested in switching production to hydroponics for both water savings, but also to access those export markets that are really lucrative. So how can we generate ideas that we can then pitch to our missions and that align with their strategies to close these financing gaps? And then DCA is able to leverage scarce development resources, which is increasingly an environment that we're facing. Our average leverage is about 18-to-1, and the way that we get that leverage is not every loan in a portfolio of loans is going to default. So we put aside money to cover anticipated defaults based on complex risk analysis that we do not need to get into, but it allows us to put in a certain amount of money and really grow that amount of money into a healthy facility that can meet market demand. So per that leverage, what we're trying to do is really shift the development financing paradigm. So as you see on the left-hand side, you're all very familiar with grants. Grants are great, but that part of the pie doesn't grow as much as we might like it to. And so we're a mechanism to push commercial finance out into sectors that are critical for development and really unlock that private capital that often banks or MFIs are sitting on and don't have the risk mitigants to push that capital out into priority development sectors like water or like technology. So just a couple of guiding principles that I want you guys to understand so that when we think through the models, you have these in mind. So mission alignment we already talked about. It's really important that we have a true risk-sharing partner in the bank or financial institution, and that's why we maintain that 50% guarantee. So I have had a bank say, I'd like an 110% guarantee, and I've said, we can't pay you to make these loans, I'm very sorry. But it's just crucial that the bank is following their own processes on monitoring loans, on following up on collections if there is a default, and that 50-50 risk share allows that to happen. And also allows decreased moral hazard on the bank side. Of course, on the moral hazard side, we ask our financial institution partners that they don't advertise to their clients that their loans are guaranteed, so that on the borrower side, borrowers are following through on loan payments the way that they would without a guarantee. There are two fees to use a DCA guarantee. One is paid up front to ensure commitment of the financial institution, and the other is paid on the average amount of loans under coverage. And those are both paid on the guaranteed portion, so not on the whole, on the guaranteed portion. And then as is evidenced by this conversation today, we feel strongly that our guarantees are most effective when they're linked with technical assistance. And that can be technical assistance on the lender side to get a lender to develop a new product that's really tailored and targeted to a particular gap in the market. It can also be on the borrower side to help a borrower figure out how to present themselves to a bank or develop a business plan that is applicable. Finally, we do not work with sovereign borrowers, but we do have the facility to work with sub-sovereign borrowers such as municipalities in areas where municipal finance is feasible based on the legal and regulatory structure of a country. And we're really focused on additionality. So we don't want to put guarantees in place that support business as usual for financial institutions. We really want these to be on the cutting edge, pushing financial institutions into markets that they haven't previously been serving. So those are our guiding principles. And the reason why that slide is up there is because as you delve into these hopefully not too intimidating models, we can brainstorm about how to grow these to shape and fit the Jordan context. So there are 4 typical guarantee products the DCA offers. A straight up loan guarantee is where we have a lender, let's say in this case a bank. We have a borrower, let's say in this case a large farmer looking to invest in a hydroponics system. And we provide a 50% guarantee on that loan from the financial institution, from the bank. And if the borrower defaults, DCA is on the hook for 50%. So that's a very hopefully easy product to understand, and everything else is kind of built off of that theory. In addition to the loan guarantee product, we have a loan portfolio guarantee product, and that's where we have one lender, say a microfinance institution, and a series of borrowers. So it could be many borrowers in the agriculture sector. And what we do for a loan portfolio guarantee is we define the sector and we define the kind of project that we're looking for and the kind of borrowers, and that's all done in conjunction with the financial institution and our missions. And once that definition is in place, the lender can put a loan under the guarantee as long as it fits those descriptions. So we do not do a loan-by-loan approval in this case. It's up to the bank to follow the guidelines that have been established in our agreement with them. And as long as the loan meets those criteria, the borrower meets those criteria, the loan can be put under the guarantee. Finally, 2 other structures. We have a portable guarantee product, which is where a borrower, a company, is looking for financing and they are shopping around to lenders. We have put guarantees in place that sit with the borrower that the borrower can then take to shop around to various lenders. And once they find a lender, we convert that to a loan guarantee and sign an agreement with that lender. The portable guarantee, we are actually trying to move away from that a little bit by providing a letter of intent early on in the loan guarantee process that a borrower can use for that shopping around. It just eliminates a bureaucratic step for us and for the partners later on. And then finally, a bond guarantee, which we've seen a lot of success with. We're guaranteeing, we're underwriting the risk on a bond issuance and guaranteeing 50% of the repayment. We've seen a lot of success with municipal finance and bond guarantees. And I'll present an example that could potentially be applicable in Jordan later. But in that situation, with municipal finance, if the legal and regulatory frameworks are in place, we could, for example, have a municipality that raises funds through a bond issuance that we are guaranteeing. So these are our 4 main products. Okay, so this slide is probably redundant after Radia and Raed's excellent presentations. As we know, water scarcity is a big issue in Jordan. Agriculture uses a significant amount of water, and water tariffs are low, and so incentivizing water savings just by cost savings is not particularly effective. So the questions that we've been looking at is how can we close financing gaps to encourage improved crop production using less water per the slides that Rod previously presented? And can we finance scaled water projects either through CBOs that have a natural market accessing, you have 177 CBOs, and they have a robust list of clients. That's a ready-made market right there. So looking either at projects that are small loans but have great scale, or larger projects that are, say, on a community level, more oriented towards project finance or community water use. So I'm going to present some hypothetical models. I will just say that one thing that I've heard consistently is about the need for Sharia-compliant financing. So I'll just put a note to say that we have done some Sharia-compliant transactions, and that is something that we can do and are excited to look at. So if you see us talking about interest, just know that there are ways that we can work with financial institutions to tailor that to the Jordan market. Okay, so the handy numbers will hopefully be good guidance for these next few slides. So this first idea is a loan portfolio guarantee to support first adopters of water-saving technology. And we can define that broadly, but for the sake of keeping thematically, let's talk about hydroponics. The one unique component of this idea, this is essentially referencing the previous slide, a loan portfolio guarantee. But one of the DCA has something called a gift subsidy, and it's showing up in the slide, and I realize I haven't explained it. But so we have a gift subsidy mechanism, and what that means is that we can actually accept financing from external parties, for example, host country governments, other donors, and the private sector to fund DCA guarantees. So in this model, hypothetically, let's say that there is great interest from the private sector to encourage hydroponic adoption, and USAID together could establish a loan guarantee facility, 50% guarantee, for loans made from financial institutions to first mover technology adopters. And those financial institutions could be banks, MFIs, or private sector company non-bank financial institutions, which we have seen previously. Those lenders would make loans to a series of borrowers who could be demonstration farmers who have worked closely, for example, with the Eco-Consult program adopting hydroponic technology, or smallholder outgrowers in the area who are selling to larger exporters. And DCA provides a 50% guarantee on the loans, and if first movers default, we pay 50% of the realized loss. And then simultaneously, per our desire to link with TA, USAID technical assistance can come in on both the lender and the borrower side to assist with both developing a product for technology adoption and encouraging people to understand and implement hydroponic kits appropriately. And demonstration farmers provide a connection with export markets, selling their products, and those are their outgrowers. So we have the higher crop per drop outcome that Ryan presented in his slides. So this is one example. We have just on the private sector company, non-bank financial institution, because that's a mouthful and sounds confusing. But last year we did a guarantee in India with a company that had established a non-bank financial institution specifically to provide financing for people who were going to their distributors in the country, couldn't get financing from the distributors. And so instead of going to the distributors, these clients could come to the non-bank financial institution that the company had set up and get financing from them. So I think the private sector is starting to think about providing access to finance in ways that are maybe a little bit more structured than their traditional, like selling on credit. And DCA could slot in nicely with that, that kind of model. So that's a loan portfolio guarantee idea. Another loan portfolio guarantee ideas on the CBO side, thinking about how to grow that pie that has been established through grant funding. And it's revolving, which is great, but as Rania said, at any given time you have 5 to 90 people on a wait list, so how do we really tackle the wait list? I think the trick here is going to be finding lenders that are willing and ready to lend to CBOs and getting CBOs ready to take commercial financing. If that relationship can be figured out, which is a tough nut to crack, a DCA guarantee could sit on the upstream lending from a bank or an MFI to a CBO. And then the CBOs are on lending to farmers who are purchasing catchment systems or drip irrigation or maybe family farm hydroponic kits. So just another example on the CBO side. We're also brainstorming around maybe figuring out a way to put the guarantee in the same place, guaranteeing a CBO loan, but maybe it doesn't come from a traditional lender. Maybe it comes from a company that has set up a non-bank financial institution. Okay, so this is a bond guarantee example looking at supporting municipalities investing in water-saving projects. So in this scenario, in number one, you have your commercial investors, and they purchase bonds issued by a municipality through an underwriter or an agent. The municipality invests in scaled water projects. Maybe that's desalination, maybe that's gray water reuse. And as the projects recoup costs, the municipality repays investors, probably through a trustee mechanism. And the DCA guarantee sits on that repayment to the commercial investors and would cover half of their realized losses in the case of the municipality defaulting. And in this situation, which we have some examples in Eastern Europe, in Serbia, we have issued a bond guarantee with the city of Novi Sad for water infrastructure, specifically pipes and water treatment facilities. And in Senegal as well, with the city of Dakar. So USAID could come in and assist with technical assistance on both the project level and also on the municipality side. And U.S. Scott's office does have a robust program working already on pre-feasibility and feasibility studies, which is a big component of this. So that's a bond guarantee example. And then finally, a portfolio of portable guarantees. So bear with me here. This is a model that we haven't actually implemented, but could have implications in the renewable energy and the water sectors. So if you had a developer providing an equity stake, DCA can only guarantee debt. We can't guarantee equity. But if you had a developer providing an equity stake in a group of projects, and then a debt transaction, so a bank or a fund that's providing debt to individual projects within that pipeline, the DCA guarantee could sit on that debt transaction between the bank or the fund and the project for project finance. As you know, if a project defaulted, then USAID would pay 50% of realized loss. So it's not dissimilar to a loan guarantee. It's just the within a pipeline framework. And again, technical assistance with pre-feasibility and feasibility studies could sit on the project side. And as projects generate revenue, they repay their loans. And we looked at this in Indonesia quite in depth, and I think this could be interesting if there are specific private sector developer companies looking at water projects. So these are just 4 ideas. I'll just finish with just a couple of notes about our performance to date. So we have 451 guarantees in 74 countries. We've mobilized $3.7 billion in capital, so that's that locked capital that I was talking about before. As you can see, what we've paid in claims is actually offset by what we've collected in fees, and that's great, but I will note, like, we're not a bank, we're not in this to make money, we're in this to push financial institutions into sectors that are crucial for development. Our default rate is 2.14%, and our utilization rate across the guarantees that have expired, as opposed to projects that didn't work out and we terminated them, is 84%. So that's, of a given facility, how much has been used on average, 84%. So that's that. Yeah, I think that my final questions to you guys are, given what you've heard, and I know Scott will continue with this train of thought, but given what you've heard from Rania and from Raed, and now that you hopefully have a little bit more of an understanding of the DCA mechanism and some seeds to think about with those 4 hypothetical slides, we'd be really curious to hear from you the linkages and synergies that you see, you know, in the Jordan context, in the Jordan market, you know, who might be good lenders to work with, what are project models that we should consider to close these access to finance gaps that we know exist with regard to water saving and technology adoption. So that's that.
While you're there, Beth, please imagine, if we will, like a year from now, USAID designs a project and puts, let's say, $1 million towards a loan guarantee. How much will that mobilize on the commercial banking side?
Yeah, so the leverage is risk-based. So the more risky a transaction and the more risky the country, the lower the leverage. But in Jordan, leverage could potentially be, depending on the transaction, I would say maybe like 40 to 50 times. So that's actually quite high. Of course, if we're going to go with a really complicated structure versus a straight-up loan guarantee with one company and one lender, you know, then it could be less than that, but it would be, I think, above the 1 to 18, certainly, leverage that we see on average across our portfolio.
Okay, we've got 15 minutes left in the session, I believe, so I've concluded that everything I had to say in my summary has been covered by the 3 speakers. And I do want to keep 15 minutes for discussion. So if you 3 speakers would migrate to the podium there, we would avoid running around after the microphone. And I think it's important for us to just, one of the things that was in my presentation that hasn't been said had to do with the institutional support and strengthening projects, new socioeconomic survey results. They are not finalized. They have not been cleared by the Ministry of Water and Irrigation, so I don't feel too bad about not revealing everything about them. However, those results were so important because they highlighted the amount of water and the small number of producers that are actually using the water in the highlands. So I believe that we could really come up with a win-win solution for some of these producers in the highlands. But in addition, you have the Jordan Valley, which when you drive down into it, you're amazed by the coverage of plastic that you see. There's like 1/3 of all surface areas covered in plastic houses. And those could, I think, be fairly easily retrofitted into hydroponic production. And in Ride's paper that you will see, basically a huge portion, maybe half of the whole hydroponic kit, is basically that structure. So already you've got a discount by moving from these older systems into the newer hydroponic system where the water is being recycled. So there's no soil degradation, there's no loss and pollution, there's very much less nutrient use, and under proper conditions it can also reduce bugs and diseases. Those are obviously still a concern, but I believe that with the proper agricultural practices and agronomic techniques, all of these high production greenhouse crops can be sold for huge profits in markets of opportunity in Europe. So let me open the floor for discussion. Sit down.
Thank you, Scott, and thank you, the panelists, for the nice presentations. I have 2 questions about the hydroponic project in Jordan. Whether the government was part of this project or not, because I believe that if we're talking about something that will affect the policy, the government has to be a successful part of the project. And my second question is to USAID, if they are adopting this, any policy implications to take it and push it to the government side.
Let me ask Ride to answer the question, but let me